Looking for strategies to help you protect your portfolio in these uncertain times? Visit robblack.com. robblack.com, powered by EP Wealth.
Welcome in. The S&P 500 is up 0.4%. The NASDAQ up 0.4%. The Dow Jones Industrial Average up 0.4%. Modestly higher as stocks look to take back yesterday's losses, get back to Friday recent close all-time highs. The Dow's outperformance can be attributed to a big double-digit gain in United Health. It topped earnings expectations, with 3M also trading higher after earnings. Earnings are going to lead this market higher if inflation doesn't rear its ugly head due to higher oil, which is very likely due to how long it's already been prolonged above 85. But it's not problematic long term, so Wall Street may look past it and look towards the new Fed Chairman Warsh, who will likely get nominated. It's not going to be a smooth transition, but I expect us to be higher 6 months from today. And earnings are looking fantastic so far. Amazon's trading 2.1% higher after an expanded partnership with Anthropic. More on that in just a minute. But there's ultimately optimism around a U.S.-Iran deal keeping oil prices tame. A sizable batch of earnings reports with some notable movers in the mix today. Strength in consumer, discretionary industrials, energy, and materials. Taking a look at the actual numbers, because I know some people like those. The S&P 500 is up 40 basis points, up 22 points to 71.31. The Dow Jones Industrial Average is up 60 basis points. That's a little bit more than 0.5%, sitting at 49,743. The NASDAQ's up 1/3%, sitting at 24,496. Russell 2000 is up 2/3%, sitting at 2812. The VIX under 20. That could change in the next 24 hours if tensions don't evaporate a bit, because they feel a little high strung right now, with Iran saying, we've got cards. We're not done playing yet. But more on that in a minute as well. Bitcoin sits up $1,146 to 76,219. Crude oil sits at $87.43 a barrel. Dow component United Health is up 7.5% this morning after topping earnings expectations, aided by a lower than expected medical cost ratio and issuing above consensus guidance for 2026. Apple is down slightly today. They have to be the big story. And on some levels, I'm really happy for them. I didn't get emotional yesterday when I heard that Tim Cook is stepping down, but he did better than anyone ever thought he would be coming off of Steve Jobs. And he turned Apple from a product company into a full slate of wearables, healthcare, services, stuff that wasn't really that important, tablets under the Steve Jobs era. Tim Cook stepping down as CEO of the company said he'll be exiting his position September 1, so right before the foldable phone comes out. He's been in the role since 2011. He's 65 years old. He's going to become executive chairman of Apple's board of directors. John Ternus, currently Apple's senior vice president of hardware engineering, will become the new CEO. Tim Cook said the right thing where he said it's been a privilege. It's been the greatest privilege of my life to be the CEO of Apple and to have been trusted to lead such an extraordinary company. Cook was named CEO on August 24, 2011, after founder Steve Jobs resigned after finding out that he had pancreatic cancer, which is just deadly. And there's some good news today on pancreatic cancer, but more on that later. It's an mRNA breakthrough. Cook had big shoes to fill. Under Jobs, Apple changed the game when it came to personal computers and smartphones. Cook brought in an era of new innovation that kept shareholders excited. From the close of August 24th, 2011 through Monday, Apple shares have gained 1,932%, with a total return, including dividends, of 2,323%. It's my largest position, and I didn't flinch when Steve Jobs named Tim Cook CEO because of his expertise in supply chains. Cook led the charge at Apple with the wearable segment. Apple Watch launched in 2015. AirPods launched in 2016. The wearables integrate with other Apple devices beautifully, incentivizing purchases and giving Apple one of the most sticky ecosystems in tech. He also focused on the growth of Apple's services segment, including the launch of Apple Pay in 2014 and Apple Music in 2015. The services segment is Apple's highest margin business. If you take a look at Apple with its 2,000% returns versus NASDAQ at 1,200% returns in the same period, and the S&P 500 just 580% returns. There's no doubt about it. He's been a great CEO and a solid leader who hasn't gotten into too many missteps, either politically or with product-wise. AI is probably their biggest underwhelmer. Apple's under pressure to deliver better artificial intelligence in this next product cycle, following the delayed rollout of AI-powered Siri. Robotics is also an area of potential growth Apple shareholders are watching. John Ternus is a long-term Apple employee. He joined the product design team in 2001, became a vice president of hardware engineering in 2013, senior vice president of hardware engineering in 2021. He helped launch products like the iPad and AirPods. He most recently worked on the MacBook Neo. While executive changes at Apple are rare, John Ternus, he's been at the company a long time. He's been around the iPhone a long time. Evercore analyst Amit Daryani said, "We don't expect any material change in Apple's near-term strategy." Iran's ceasefire is set to end tomorrow. That's the other big headline today. Fed Chair nominee Kevin Warsh is testifying. We get Tesla's earnings tonight after the market. But let's get to what President Trump said this morning, because it's a laundry list of things we could watch. Iran is attending the meeting because they know they have no choice but to attend. He expects a great deal with Iran. The U.S. is in a very strong negotiating position. Trump said the new leaders of Iran are much more rational. He said the Iran blockade has been a tremendous success. He said Iran cannot get themselves on a good footing unless they make a deal. Iran doesn't have much time before the ceasefire ends, which is tomorrow night. He doesn't want to extend it. Iran is trying to move their missiles around during the ceasefire. He had a lot to say this morning. Trump also said the military is ready to resume bombing. He says he expects to be bombing Iran because it's a better attitude to enter the talks with. He wants to find out why the Fed spent so much money on building renovations when he's tearing down the White House and building an add-on. It's just bizarre. If you don't think we live in a bizarro world, this is not normal. But then again, I grew up like red, white, and blue. My father was in the military. We loved our country. We loved our flag as kids. So this is just bizarre to me. Comments from Democrats are hurting his negotiations. Conducting a swap line with the United Arab Emirates is under consideration. That one is one I want to know more about. We should not be borrowing money from the UAE. He says Anthropic is shaping up and starting to work with the U.S. government. He thinks it would be brilliant if big companies like Apple and Amazon decide not to request refunds on tariffs, of which UPS and FedEx have requested refunds on tariffs. I want to see how much Apple and Amazon are going to get back, because that could be a windfall for their earnings next year. But it's already well known, don't forget, because the tariffs were ruled illegal months ago. So Wall Street knows this. United Healthcare, a little bit more about their numbers. Annual adjusted earnings per share are going to be $18.25, up from the previous floor of $17.75. For the first quarter of 2026, the company reported annual earnings per share of $7.23, higher than $6.58. So the quarterly numbers are good. The outlook for the year is good. A medical cost ratio of 83.9%, lower than the 85.5% that was expected. The company said the decrease in spending on medical care was driven by strong medical cost management and favorable reserve development. This has been a stock that was such an amazing leader for so many years. And then things started to fall apart in healthcare. And America started to blame healthcare CEOs. And there was a disruption, to say the least. The sector has been under pressure in the past year as the cost of providing care, particularly for those on Medicare, has gone up. United Health was able to grow its Medicare revenues by 1%, despite having about 1,000 fewer members by raising the price of its premiums. Humana's up on this news, up 5.2%. Ticker symbol HUM. CVS is up 1.3%. Elevance Health, ticker symbol ELV, is up 3%. Centene up 3.4%. Molina Healthcare, ticker symbol MOH, up 3% as well. So that's one that's really good for the sector. And as you're looking out for the year, you don't want just AI to win. You want to see other players participate as well. GE Aerospace's quarter came in sharply better than expected in both defense and commercial. Orders rose 87%. Revenue increased 25% to $12.3 billion. Defense was a highlight and should continue, in large part due to President Trump's $1.5 trillion budget proposal. Asian U.S. travel issues were there, but management maintained its prior guidance, which is why the stock's down 4% today. They make jet engines, GE Aerospace. GE Aerospace hit an air pocket in March as the start of the U.S. war in Iran sent energy prices soaring and hurt expectations for the profitability of commercial carriers. The more profitable commercial carriers are, the more likely they're to buy new jets. A rally in April has pushed the stock close to positive territory for the year, but it's solidly in the red after the results of today. Lucid climbed today after Uber was revealed to be its second largest shareholder following recent investment. I was a little bit shocked by this. I own some Uber and I'm not crazy about this. Uber is now the second largest shareholder, trailing only Saudi Arabia's PIF sovereign wealth fund. Uber and Lucid are going to expand their robotaxi partnerships from 20,000 to 35,000, along with the expansion. Uber also said it would invest an additional $200 million in the EV maker. Lucid stock is down 29% in April. It hit an all-time low of $6.75 on Monday. Amazon is boosting its investment in cloud maker Anthropic. Fought another $5 billion now with the option for $20 billion more if certain commercial milestones are reached. Amazon's expanded collaboration represents a significant escalation in AI infrastructure race, combining strategic equity investment with a massive long-duration cloud consumption agreement. The $100 billion Amazon Web Services spend commitment directly addresses investor concerns around monetizing generative AI by providing tangible, recurring demand for compute-intensive workloads. At the same time, the deal strengthens Amazon's competitive positioning versus Microsoft and Google by pairing its infrastructure scale with a leading third-party model provider, enhancing ecosystem breadth. The capital intensity required to support this growth, spanning chips, data centers, and ongoing investment in Anthropic, introduces near-term margin consideration that investors will closely monitor. Ultimately, the key question is going to be execution. If Amazon Web Services can efficiently translate this demand into high-margin growth while scaling its AI infrastructure, the partnership could meaningfully accelerate Amazon's cloud trajectory and reinforce its long-term leadership in enterprise AI. CrowdStrike got an upgrade today from hold to buy, saying Anthropic's powerful Mythos models is actually a tailwind for the cybersecurity provider because it'll make companies spend more on protection. CrowdStrike has the full suite of cyber tools to win and not to be displaced. It's one of Jim Cramer's favorites. Citigroup raised its price target on Coherent to $420 from $250. That's a big increase. It shows you how important the replacing copper theme in networking with optics is playing out. Speed of light, a lot less heat. Corning's another name in this industry, as is Lumentum. Truist, a big research firm, talked about earnings next week for big tech, and they see a big upside surprise from Alphabet. Analysts projected its second best top-line growth since 2022, fueled by strength in Google Search and Cloud. Analysts were also upbeat on Meta Platforms, predicting its fastest revenue growth since 2021. Alphabet, Meta, Microsoft, and Amazon are going to report on April 29th. That's going to be a busy night for me where I sleep maybe 30 to 40 minutes at a sweep and then get back up early again. Tesla reports first quarter earnings this afternoon. Nope. Wednesday. My bad. I'm on the wrong day. But they report on Wednesday. It had a delivery miss earlier this month in which the company produced 50,000 more vehicles than it sold. Expectations are for revenue to be $22.3 billion, up 15% year over year. Earnings per share of 36 cents. Free cash flow of negative $1.4 billion. Pressure on that free cash flow is going to be a key focus. The expected decline reflects a combination of lower regulatory credit revenue, ongoing pricing pressure to move inventory, and rising capital expenditures, which is projected to climb significantly this year. CapEx is really a bottom line issue for a lot of people on Wall Street. They don't like how the Magnificent Seven has to spend, and I'm telling you, Tesla's spend of only $20 billion is small. I don't know how they're going to keep up in AI after losing basically every founder of XAI, except for Elon, and only spending $20 billion. So they've got the robotaxi that they're going to tell us a little bit more about. They expanded to one more car in Dallas, putting the total at one, and one more robotaxi to Houston, putting the total there at one. But it's 4 markets, and something tells me people are pretty stupid with math, and Elon Musk will say, hey, we doubled our size of our markets. Investors are going to be listening for progress on Optimus after Tesla said it plans to repurpose some existing vehicle manufacturing capacity towards humanoid robot production. This is part of CEO Elon Musk's broader push towards an autonomous future. Analysts expected growth to be driven more by newer businesses versus autos, as investors weigh whether growth in higher margin segments can help offset ongoing pressure on automotive margins. China's kicking our butts in EV, and Elon Musk is the king of American EV. China's kicking our butt in robots. If you haven't seen the China Robot Marathon or Half Marathon, check it out. It's wild. It's on YouTube, and it'll actually make you smile a little bit. You know, one robot ran faster than any human for that period of time, totally autonomous. And another one fell flat on his face, which is kind of the funny part. So Chinese smartphone manufacturer Honor won the half marathon race for robots in Beijing. Its bot wrapped up the 13 miles in 50 minutes and 26 seconds. That's faster than Jacob Klipimo, who holds the world record for finishing in 57 minutes. Faster than last year's winning bot, which finished in 2 hours and 40 minutes and 42 seconds. That's a pretty big improvement in 1 year. And it just got me thinking of, are we going to get to a point where robots are running on the sidewalk or in the bike lanes to deliver us stuff? It'll cost, they say, about $1, depending on where the robots are located, and there's other issues, but that's kind of the world we're looking at sooner rather than later. Let's talk about a breakthrough in mRNA cancer treatment. A pancreatic cancer diagnosis is typically grim, with just 13% living for more than 5 years. 13% of patients living more than 5 years. New data from a clinical trial showed that 7 out of 16 patients who were given personalized mRNA vaccines responded to the treatment and are still alive 6 years later. The vaccine works like immunotherapy after cancerous tumors are surgically removed from an early stage pancreatic cancer patient. They're used to create a vaccine that trains the patient's immune system to fight off lingering cancer cells from the future. It's the same mRNA technology that was used in COVID vaccines, which studies estimate saved millions of lives. Don't forget, it's weird that when women have babies, their body teaches them to forget, in large part because it's such a traumatic experience for the body. And women wouldn't want to go through it a second time, but if their bodies forget, they're more keen to do it. They say with COVID, 1 million people died. And we've kind of forgotten how wearing masks, that period's a little foggy in my head. We were locked up. But anyway, back to mRNA. Scientists warn that mRNA still needs to be studied more as a cancer treatment. A larger phase 2 trial is in progress. But Revolution Medicines also reported that a separate treatment, a pill called daraxonrasib, has nearly doubled a pancreatic cancer patient's life expectancy compared with chemotherapy. Despite doctors saying mRNA technology is safe, Health Secretary Robert F. Kennedy Jr. and other Trump administration officials have questioned the technology and put research dollars in limbo. In February, the FDA said it wouldn't review a new flu vaccine that used mRNA technology, but quickly reversed its decision following backlash. So I see that as good news. Let's take a break here. Don't forget I have a newsletter you can sign up for at robblackshow.com. You can also drop me an email. If you want me to review a question that you have and get back to you an answer, if you want me to review your retirement situation, I'll give you some questions and we could chit chat through email and then set up a Zoom call, maybe a lunch. I'm at the point in my career that I'm not working for money. I'm working to do good work and to make some connections with some people that have been on my journey, and it's been a good journey. It's been a really good journey. I'm quite pleased with where I am in life. You can find me online at robblackshow.com. I got 2 more segments coming up for you. Stay tuned.
The markets are more volatile than ever. Inflation, interest rates, global uncertainty. If you have $500,000 or more invested, ignoring it could cost you your future. At EP Wealth Management, they offer a free preliminary financial plan, a chance to identify potential risks in your portfolio before the next downturn hits. Get insights from Chad Burton, CFP, and Rob Black, trusted voices in financial planning and retirement strategies. They'll help you spot hidden risks, rebalance thoughtfully, and uncover opportunities to grow and protect your wealth, even in turbulent times. Their goal? To help you feel more confident about your financial future during uncertain times. Don't wait for the markets to decide your future. Schedule your complimentary preliminary financial plan at robblackshow.com. That's robblackshow.com. EP Wealth Management. Plan smarter, live better, no matter what the markets do. Investments not FDIC insured. Past performance does not guarantee future results. Not an offer to sell or a solicitation to buy any security. Member FINRA SIPC.
Thanks. Don't forget I have one more segment after this one. A little bit about a price target maneuver and some words of wisdom from Warren Buffett. That's in the 3rd segment, but I still have a lot of content to get today's 2nd segment. We're dealing with a deadline. Pakistan is sending out a press release saying, we've asked Iran to show up for these peace talks, but so far they haven't responded. We encourage them to show up for these peace talks. Peace talks could end with a little volatility. Maybe Trump chickens out. Maybe Trump throws a bomb at one bridge or a couple buildings. I don't know. Politically speaking, he's not easy to pin down. Markets have turned negative now this morning. The S&P 500 is down 11 basis points, sitting at 7101. The Dow Jones Industrial Average is basically break even, and the NASDAQ is basically break even. Russell 2000 up 0.25%. Bitcoin's pulled back up only $20 now at $75,767. Gold's down 1.4% to $4,700 an ounce. Oil's moved back higher, probably on those Pakistan numbers. It sits up 1.5% to $88.77. 10-year Treasury sits at 4.3%. 2-year Treasury yields up for 30 years sits at 4.9%. Interesting stuff, how the markets have changed in the last hour. Some stocks that are big movers today include United Healthcare up 7.5%, GE Aerospace down 3.4%, Northrop Grumman fell 3.9%. They're the guys who make the stealth bombers. They should be doing better right now, but they are big contracts that take a long time to deliver. Sales were up 5% year over year. New awards totaled $9.8 billion, leaving backlog at $96 billion, more than 2 times annual sales. D.R. Horton up 8% after the home builder reported better than expected second quarter earnings. Alaska Air down 1.1%. They suspended its full year guidance, citing higher fuel costs. Tractor Supply down 8.3%, worst performer in the S&P 500. They missed Wall Street expectations for the first quarter. This has been a wild stock is Avis. They're up 10%. Short squeezed recently on the company. Similar to GameStop. Car rental company has risen over 400% in the past month. Just 2 investors effectively own more than 100% of the shares outstanding. Caterpillar is a stock I own, tied towards income and retirement. But also, it's given me growth. I didn't know they were going to get this AI warehouse data center build. Wells Fargo analyst Jerry Revich raised his Caterpillar price target by 10% to 960 from 870, suggesting 20% upside from here. He is using AI to track projects, and he found permits for 600 megawatts of power generating equipment likely headed for Ohio for Meta. Meta didn't respond to a request for comment. Revich, the analyst, said, "We note strong gas compression demand is consistent with our checks, suggesting pipeline project plans are up to 3 times up year over year. Caterpillar stock is up 39% this year and up 180% over the last 12 months. The average analyst price target for Caterpillar is $746. About half of the analysts covering Caterpillar rate the stock a buy. Some dividend aristocrats that I've been looking at recently. I want to start throwing maybe a segment a week into income producing stocks. And are they appropriate for you and or not? Again, this would be for someone who's 50 plus who has secured the amount for retirement that they need. My basic rough needs were somewhere between $4 million on the low side, which would pay me about $160,000 a year in income till the day I died, and $10 million, which would pay me about $400,000. But I secured more than that, significantly more than that. So I'm wise now to start taking a look at opportunities to add to the dividend income stocks that I'm going to want in retirement, that I'm going to be able to pass on to my kids, hopefully, if all goes well, and none of them go out of business. The idea that they've been raising dividends for 10, 15, 20 years gives me confidence that they'll be around in 10, 15, 20 years. Cisco raised its dividend, and I'm not talking Cisco Systems. I'm talking Cisco, the food delivery company, SYY. They raised their dividend by a penny to 54 cents a share. Colgate raised its payout by a penny. Chubb increased its dividends by 5 cents to $1.02. Other aristocrats such as Johnson & Johnson and H.B. Fuller have also raised payouts in recent weeks. They've rallied sharply this year, but they're considered more expensive on a how do you compare company A to company B level. So Cisco, Colgate, Palmolive, and Chubb, a big insurance company, are doing quite well as far as valuations, and they got that dividend. Cisco tumbled sharply in March when it announced plans to acquire restaurant distributor Jetro Restaurant Depot for $29 billion. It's regained a lot of that ground, rallying about 10% from its March lows. It's got a dividend yield of 2.9%. Investors should be able to count on a total return of more than 10% in that year. If you take a look at it, ticker symbol SYY, what I want you to see as an income investor, potentially in retirement, is take a look at a chart. If you're going to be spending 20 to 30 years in retirement, take a look at the last 20 years. Stock's gone from $16 a share to $75 a share. That's an amazing return with a dividend yield of 2.88%. Now, again, that's going to change, but it's a pretty boring company. They deliver food to restaurants and cafeterias and colleges. They do fresh produce. They do dry food, canned. They do prepared entrees, fruits, vegetables, seafood, meat, frozen food in some segments. Is it perfect? No. But I'm looking for a dividend that's consistent. Some other stocks that are considered cheap right now, as far as dividend aristocrats go, Colgate Palmolive. Shares have tumbled about 12% in the past year thanks to cost pressure and gloomy consumer sentiment. That's knocked the PE from 25 down to about 21, which is still very high compared to the market. Not compared to the market, but for a boring stock that isn't going to grow terribly fast. It sells more than 40% of the world's toothpaste. It's hard to argue that people are going to want their teeth to rot and fall out. Analysts are forecasting solid growth of 4-6% in the next 2 years, a 2.5% dividend yield. So let's do the same thing with Colgate Palmolive that we just did with Cisco and take a look at the chart and see how it's performed in the last 20 or so years, because that's going to be how long you own it in retirement. The ticker symbol on the company is CL. And this company has been around since at least the mid-'80s. Back then, you could have got it for $1.60 a share. Now it's $82 a share. Again, a phenomenal run. But let's just look at the last 25 years. Maybe that's how long you're going to be in retirement. It's gone from 24 to 82. If you've hit the amount of assets that you want to accumulate, again, mine was somewhere between 4 and 10 million. I've got significantly more than that. But I've hit that. So I don't need the pure growth anymore. I still have a lot of it. Don't get me wrong, but it's gone from essentially $24 25 years ago to $82 with a 2.5% dividend yield. PE ratio is a little high right now, in my opinion. But its all-time high is $100, $99.33. It's currently at $82. That qualifies for me. Now, again, do I expect the stock to do anything in the next 5 years? The answer is a big resounding no, except to pay for its dividend. If it happens, would I be thrilled? Sure. So Chubb's also on the recent list of companies that hit a good valuation, but also pay a nice dividend yield. This is an insurance company. Its dividend yield is about 1.18%. So that's on the smaller side compared to the first two that I talked about. But the PE is also 12 times earnings, which makes it interesting, to say the least. For the record, when we're talking about financials, you're really talking about insurance companies, you're talking about banks, and you're talking about brokers. And the insurance companies are the most boring because they're insuring something that they have big payouts on. I hope that makes sense to you, that's why it has a below market multiple. It's the property and casualty insurance company. It's amongst Berkshire Hathaway's holdings. Analysts expect profit growth of 8 to 9% over the next 2 years, dividend yield of 1.2%. So they see more profit growth than average. That's nice to say. Higher gas prices helped drive retail sales up 1.7% in March. That's not the greatest story. Retail sales surged in March, but much of the gain was driven up by higher gasoline prices. Higher tax refunds likely helped blunt the squeeze, but that momentum may not last. Retail sales for all of consumer spending rose 1.7% month over month. Again, but unsurprisingly, the big spending was tied towards gas stations. Again, that's not the best scenario to be talking about. So ships are stuck in the Strait of Hormuz, but Wall Street's been on a bullish run. We'll see after this latest ceasefire. Politics, right? We're having a rip-roaring start to earnings season, giving Wall Street plenty of evidence that the bull case is still there. Ed Yardeni talked to Bloomberg last week saying history shows that geopolitical crises turn out to be great buying opportunities. Investors are looking past the war. And after looking past the war, investors found plenty of upside. The rally was fueled in part by big tech. The NASDAQ had its longest winning streak since 1971, and that's the S&P 500 as well. Of the 10% of S&P 500 companies that reported through Friday, FactSet found that 88% reported actual earnings per share above expectations. That beats both a 5-year average of 78% and a 10-year average of 76%. Meanwhile, all 11 sectors had reported year-over-year revenue growth with strong revenue figures in the financial sector, pushing the overall growth rate up to 9.9%. If that holds for the rest of the earnings season, it would mark the highest figure since the third quarter of 2022. I've got one more segment coming up. Find me online at robblackshow.com.
You are listening to the Rob Black Show podcast. For more information on EP Wealth, visit robblack.com. That's robblack.com.
Morgan Stanley analyst Eric Woodring projects Apple shares could hit $300 by September. Wait, what? He's always been kind of like the axe on Apple. Some people see as high as 325 and 350. But the guy who is the low-level confidence guy in Apple is saying their revenues look good. Apple has multiple catalysts for strong revenue growth. Investors shouldn't be spooked by any hit to the company's margins because rising memory costs. Wait, what? The rise in memory costs, we know, are going to make phones more expensive. And he says, don't worry. He sees a path for us to get there by September. And if you look at the calendar, we're already in April, so it's May, 1 month. June, July, August. It's about 4.5 months. His optimism comes from during a challenging time for tech hardware companies. Memory costs are surging. Memory is a critical component for your computer, for your cell phones, for your watch. It's used to power artificial intelligence, making it a hot commodity as demand is spiking. This has put cost pressures on Apple hardcore, pressuring margins of PC and smartphone companies, leading to many of them raising prices. Apple hasn't raised prices. Apple's size and strength gives the company an advantage when negotiating memory prices with suppliers. But costs are still rising. Apple might say when reporting earnings on April 30th that margins may be pressured in the near term. But this analyst, Eric Woodring, isn't having a lot of it. I find that interesting. He wrote, revenue strength and a possible strong financial outlook for the June quarter should offset any concerns. Memory inflation will pressure margins, but this is well known, and the iPhone revenue's upside sets for better than feared June quarter guide. He rates the stock at overweight, $315 target, but in the short term, he thinks it can go to $300. He thinks Apple stands out as large tech peers as against them as the company continues to report strong free cash flow, while competitors continue to spend massive amounts on CapEx on building out AI infrastructure. It should be mentioned that Apple hasn't spent hundreds of billions of dollars. They're going to spend $1 billion to use Gemini's software, AI software. Dell stock is moving higher, up 4%. Cisco is up 1.5%. eBay was up 2.3%. All three have outperformed the market in 2026. Dell's kind of boring old tech company, but they're up 56% this year. Stock's up 130% in the last year. What up with that? This year, Dell decisively broke out of an 18-month consolidation period, as has eBay, as has Roku. I don't want to say I want to cheer because that makes me sound weird. That wasn't me. That wasn't me. Young investors rattled by ups and downs of the stock market amidst the war, economic uncertainty, and artificial intelligence.
Right? God.
And the disruptions that it's having. College costs are creeping higher, $140,000 for an undergrad degree out of state. That's insane. Up to $200,000 for a private school, if not more. But young investors are a little rattled. And what I have here for you is Article A. Let's present him. Ladies and gentlemen, it's Warren Buffett. He's 95 years old. He deserves a little respect, my buddy. He's lionized. He's lionized. Can people say that about me one day for his investing record during 6 decades, top holding company Berkshire Hathaway?
Hey, man, I'm 91 years old. Got that? I deserve a little respect from you, my buddy.
That's not him, but it could have been him 44 years ago because he's 95. He owns See's Candies to natural gas pipelines to Apple shares. I will say this. I don't really like See's Candies. The fact that they make people wear those clothes at the stores is so embarrassing.
Get in my belly!
But we do like butter and sugar. He says market corrections are normal. He stepped down as CEO of Berkshire at the end of last year. So 3 times since I've taken over, Berkshire, it's gone down more than 50% in the stock market. He's not freaked out by them. If you're investing for decades, which is likely reality for people in their 20s and their 30s, you'll see your share of market downturns. That doesn't make them less scary. There's a company called 1650 Wealth Management. He recently heard from a 20-year-old University of Michigan student whose portfolio had declined approximately 10% from its peak. The investor had a very small account investing in the S&P 500, and he was worried about it and wondering if he should sell his shares. He had not experienced a decline before. Many of you haven't. We buy the dips until we don't. And when we don't, we go down 10, 15, 20%. Warren Buffett saw 3 50% drops. I've seen 1. And I wasn't picking up a second job, but I wasn't not thinking about picking up a second job. If you're in a well-diversified portfolio, you're going to be A-okay. It's a short-term blip. $10,000 investment in the S&P 500 in 2006 would have grown into $81,000 by the end of 2025. $10,000 in the last 20 years grows into $81,000. But if you got out of the market because you were nervous, it would only be just about $36,000. When asked how much major tech stock prices would have to fall to become attractive, Buffett said, I have no idea what the stock market's going to do. And I don't think anybody else does either. So I invest every 2 weeks in my 401k. And last year I got some money from selling shares of a private company that I had in cash. And when Trump said, I'm going to annihilate a whole civilization, I was like, that's a good time to buy.
A mess. It's a mess.
The problem with young investors is they tend to own stocks in flashy sectors and industries like technology. They could take it on the chin hard. But someone asked me, they have a 7-year-old kid. What should I buy for my 7-year-old kid? I got $1,000. I said, buy the S&P 500. Buy the QQQ. Maybe split it between both. Maybe add in a Russell 2000 fund and split it between the three. There's no right answer and there's no crystal ball. I do say, I love talking money with you. I love talking finances with you. If there's any feedback that you have for me, drop me an email, rob@robblackshow.com. If you'd like a preliminary plan of where you stand for retirement, I can get that done for you with a CFP. Absolutely free. No sales pressure. Drop me an email, rob@robblackshow.com. Say, I'm 50 plus. I'm thinking about retiring one day. Am I doing everything right or wrong? rob@robblackshow.com.
The markets are more volatile than ever. Inflation, interest rates, global uncertainty. If you have $500,000 or more invested, ignoring it could cost you your future. At EP Wealth Management, they offer a free preliminary financial plan, a chance to identify potential risks in your portfolio before the next downturn hits. Get insights from Chad Burton, CFP, and Rob Black, trusted voices in financial planning and retirement strategies. They'll help you spot hidden risks, rebalance thoughtfully, and uncover opportunities to grow and protect your wealth, even in turbulent times. Their goal? To help you feel more confident about your financial future during uncertain times. Don't wait for the markets to decide your future. Schedule your complimentary preliminary financial plan at robblackshow.com. That's robblackshow.com. EP Wealth Management. Plan smarter, live better, no matter what the markets do. Investments not FDIC insured. Past performance does not guarantee future results. Not an offer to sell or a solicitation to buy any security. Member FINRA SIPC.